Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Guerrilla RF, and trust me, there are some twists in this story that'll make you rethink everything you thought you knew about their business, so hold tight. This company makes tiny but important parts for wireless devices, from your car's radio to big 5G cell towers. We're looking at a document that explains shares of stock that some shareholders are selling. It's a prospectus, kind of like a sales brochure for stock, so let's see what it says. First up, what exactly are these shareholders selling and why are they selling now? These shareholders, called selling stockholders, can offer up to 5,215,086 shares of Guerrilla RF's common stock. The company is not making money from the sales. The shareholders were issued these shares at different times. Some received them from private investments, others for converting debt they were owed, and others for loans they provided to Guerrilla RF. Let's look at the trading price. It shows that in April 2025, the stock was at $1.05, which was traded over the counter. Now, this company is labeled as an emerging growth company and a smaller reporting company. Basically, this means they get to skip some of the usual paperwork and rules that bigger companies have to follow. It helps them save money and time, but it also means they don't have to share as much information. But now let's talk about the important stuff, the risks. It says in big, bold letters that investing in their stock has a high degree of risk. What are these risks? Oh, there's a material weakness in their financial reporting. In plain English, this means there are problems with how they keep track of their money, and there is a chance mistakes will not be caught on time. They depend on a few big customers for a lot of their sales. If one of those customers leaves, it could hurt Guerrilla RF big time. Warren Buffett loves companies with many clients to prevent this type of risk. Government rules and trade policies, especially in China, could cause big problems. This can involve tariffs, export restrictions, factory problems, and other violations. Security risks could be a huge problem because they rely on computers and networks. Their international operations open a can of worms that can also greatly affect their financials. The market price of their stock has been quite unstable, so it might be difficult to sell when you want or at prices that are reasonable. Okay, time for the numbers. Let's break down the financial data. Revenue in 2024, product revenue was about $20 million, while it was about $14.7 million the previous year. Royalties are almost non-existent, only around 2K. Here is a key metric, gross profit. In 2024, it was $12.8 million compared to $8.6 million in 2023. So far, so good. It's growing. Net loss, and there's the catch. The net loss was around 10 ton at $8 million. Last year, it was almost $16 million. Their losses are decreasing, but still a concern. Cash. They had almost $8 million in cash at the end of 2024. This is a big increase compared to 2023, where they only had less than $1 million. It signals that they somehow managed to raise capital, and now they are not in any immediate danger, which alleviates earlier risk factor. Here is another major risk that the filling exposes. North Run, which we saw earlier, is a major investor, and if they accumulate voting power, they could limit the ability of other stockholders from influencing the business decisions. Also, if they at some point decide to cash out a big chunk of their holdings, it could create a bloodbath in their stock. Now let's dive a bit deeper, the management's discussion section. It's where they explain their numbers, what they did, and what they hope to do in the future. Key takeaway. They are excited about new customers, new programs, and snagging more market share while offsetting the high supply chain costs with product mix. That's what everyone wants to hear. It seems like everything grew except automotive product line. They chalk it up to key customers' delayed initiative. But how about more key metrics? They released 32 new products in 2024 compared to 12 in 2023. That's great. More products can lead to more customers and more money. Check out the product backlog. This is essentially future revenue they expect from customer orders. The number decreased from $5.96 to $5.44. This could be concerning. Here is a risk that we talked about earlier, but in their own words, since many of these third parties are located outside the US, we are exposed to the possibility of disruption and increased costs. They are referring to the international tension and wars as a risk to their supply chain, as well as foreign government and regulatory actions. But at least sales outside the US only accounted for about 18% of their revenue, so international supply chain issues might be manageable for now. Another risk factor is reliance on software licenses, which can cause product development costs to increase, or a redesign of their system. The revenues rely on maintaining customer relationship, and if customers are unsatisfied, they lose revenue and find it more difficult to make sales. Relations between China and Taiwan could be problematic. If you remember, that was mentioned in the risk factors. Let's look at government regulation, economic regulation in the PRC, and other countries where they sell products could adversely impact their business. And to circle back to the top and stock sales, this prospectus acknowledges there is currently a limited market for our common stock. They can't guarantee you'll be able to resell their stock for prices they think is reasonable. Lastly, they do not intend to pay dividends for the foreseeable future. That's also a warning sign that you can't depend on profits from the stock, but only if the stock price goes up. That depends on them growing as a company. But we just saw a ton of risks, so it's a bet. Depends on them growing as a company, but we just saw a ton of risks, so it's a bet on. So what is my take on all of this? Guerrilla RF is at a tricky stage. The growth in revenue and new products shows they're doing something right. And the fact that they've reduced their losses is encouraging. Their increasing cash position could help them achieve profitability and fund future product development. However, they have significant problems like dependence on big customers, China relations, and supply chain stability, and their plan is still quite risky. I would also be cautious about all of their dependence on so few people that have a lot of say in how the business operates. There you have it, a deep dive into Guerrilla RFF's world. Thanks for watching. If you found this breakdown helpful, remember to hit that like button, drop a comment below, and subscribe for more corporate deep dives.